Welcome back to The Explainer. Today we're diving into some fascinating source data and institutional research that reveals what is probably the most glaring paradox of the 2026 financial landscape. You read the news and you see companies firing thousands of people, but then you look at their market cap and their stock prices are just soaring to absolute record highs. So why exactly is that happening? Well, the underlying data we're exploring today shows us that Wall Street has fundamentally changed how it values human capital. They're pivoting away from that post-pandemic expansion mindset and moving straight into a new paradigm that analysts are calling efficiency through elimination. Let's quickly run through our agenda for today. We'll cover Wall Street's quiet layoff, the math behind revenue per employee, how AI agents are replacing middle management, some key case studies on investing lean, the brutal truth about buybacks, and finally, the macro prisoner's dilemma. So we have to start with the cold calculus of the market. The big question driving institutional research right now is simply, why is Wall Street aggressively rewarding layoffs? Well, the alpha, that gap in market understanding, has completely shifted. Think of it kind of like a gold rush. We're way past the initial hype cycle, where investors only cared about who actually makes the AI. Today, we are firmly in the operational leverage cycle. The market demands to know who is using AI to aggressively cut their own headcount. They're heavily rewarding companies that prove their technical value by basically decoupling their revenue generation from their human payrolls.
The data outlines this pivot between two totally distinct eras perfectly. The old era was all about that growth at all costs mindset. Scaling a business meant proportionally hiring more people. But now we're in the 2026 era of efficiency through elimination. Because of this, for the first time since 2016, employment across the S&P 500 has actually seen an annual decline. But here's the catch. Unlike 2016, which was driven by recession fears, this isn't a temporary reflex. The research points to a structural, quiet layoff strategy. Companies are actively using AI to permanently break that link between scaling up their business and staffing up their offices.
Let's get into the math driving this. Revenue per employee. The mathematical engine behind this whole new regime is revenue per employee, or RPE. You can think of RPE as a company's metabolic rate. It tells us exactly how much revenue one single human being is responsible for bringing in. The higher that number gets, the leaner and more powerful the company is. In our current high-rate environment where borrowing money is expensive, RPE has become the ultimate leading indicator for stock outperformance. It tracks operational efficiency and shows investors exactly how well an organization is integrating autonomous workflows. In fact, source data shows that in software and services, RPE is growing at a 10% annual rate since generative AI integration kicked in. That's up from a pre-AI baseline of just 3.3%. Let's break down the benchmarks across different sectors, because the alpha gap here is massive. Software and services companies are hitting up to $600,000 per employee. They're doing this by heavily integrating AI-driven coding and automated support, basically doing the work of junior developers. Semiconductors and electronics are pushing that even higher, up to $900,000 per head. These digital-first sectors have a huge structural advantage because their intellectual property scales exponentially without needing a physical footprint. Now, compare that to general industrial, which is hovering between $150,000 and $400,000 since they still rely on physical manufacturing. The bottom line from the data, companies in the top quartile of RPE outperform their peers by a staggering 180% in total shareholder return over a 10-year cycle. It's the absolute dividing line between companies just using AI for marketing and those fundamentally rewiring their cost structures.
Which brings us to our next point, AI agents replacing middle management.
So how are these companies hitting these crazy high RPE numbers without humans? The answer is the evolution of automation itself. We are way past step 1, which was just rigid rule-based automation. We're even past step 2, where basic large language models were just summarizing documents. Institutional research puts us firmly at step 3 right now, agentic AI systems. By the end of 2026, 40% of enterprise applications will be integrated with these AI agents. And we're not talking about clunky customer service chatbots. These are systems that can read a messy document, understand the context, cross-reference it with a database, formulate a plan, and actually execute a multi-step workflow. They literally replace the glue people of middle management. For example, JP Chase uses these agents to autonomously handle compliance reviews. An agent instantly ingests thousands of transaction logs, spots a fraud pattern, flags it, and drafts the regulatory report. All of that eliminates the need for vast teams of human investigators. Let's look at what this looks like in practice with some investing lean case studies. We've got 3 S&P 500 case studies executing this exact strategy. First up, BNY Mellon, 42%. That is their staggering year-over-year earnings per share jump in the first quarter of 2026.
So how did they do it? Well, they delivered $5.41 billion in revenue, which is a solid 13% increase. But the real story is their pre-tax margins. Those margins expanded by 83 basis points. To translate that out of finance jargon, that means an 8.3% increase in pure profitability margins. That is a massive leap for a legacy bank. BNY Mellon heavily leveraged AI for foreign exchange operations and onboarding net new business. They proved you can use technological scale to capture more market share while completely bypassing traditional hiring. They've basically become the darling of this quiet layoff portfolio.
Case study number 2, State Street Corporation. $1 billion. That's the amount of capital they returned to shareholders in a single quarter through dividends and buybacks.
State Street saw their total revenue rise 16% to $3.8 billion. But if you look closely at their filings, they booked $89 million in what they call repositioning charges. That is just Wall Street's fancy euphemism for taking an upfront financial hit to execute layoffs. Think of it like paying a huge penalty to break your lease early, just so you can immediately move into a much cheaper, better house. By rescoping their workforce for AI-driven operations, their pre-tax margin jumped to 25.5%. They showed the market that taking those upfront restructuring charges clears the runway for massive long-term margin protection.
Our third case study is in the professional services sector. CRA International hit a record 75% firm-wide utilization rate. Now, this is especially wild because professional services are traditionally super labor-intensive and famously resistant to operational scale.
Cray delivered 10% revenue growth, hitting $687 million, all while their actual consultant headcount declined. You know, the consulting industry has always been built on the billable hour. Your revenue was capped by the number of human hours in a day. But by automating core research and analytics, they completely shattered that ceiling. They are generating more output per unit of labor, decoupling time from money entirely. It's not about their remaining consultants working harder, it's about AI allowing a smaller team to deliver much higher value output.
Now, why is this relentless drive for efficiency so crucial right now? Well, S&P 500 market concentration has peaked. The top 10 positions represent roughly a third of the entire index's market cap. Because it's so concentrated, these mega-cap companies are trading at incredibly lofty valuation multiples. Investors are paying a massive premium today, expecting absolutely flawless execution tomorrow. To justify those valuations and prevent their stock from collapsing, these companies have no choice but to ruthlessly pursue operational efficiency. They literally have to prove they can squeeze more pure profit out of every single dollar earned.
And that brings us to the brutal truth of the matter: buybacks. $1.2 trillion. That is the annual labor savings opportunity that institutional research is targeting right now across the business sector. This isn't just a fun theoretical projection. This is the mathematical endgame of this tech bull run.
Let's look at the math here. Right now, human labor represents about 55% of total business sector costs. Squeezing that down to 50% via AI might not sound like a huge change, but a 9% reduction in overall labor cost translates into an outsized 31% jump in corporate earnings. That efficiency creates an estimated $878 billion in after-tax profits. And all that capital, it's being funneled straight back into share buybacks, which just inflates stock prices even further.
Analysts are calling this a literal compute for labor swap. Look at Meta. Despite pulling in record revenues, they cut roughly 8,000 employees. But at the exact same time, they projected a massive $135 billion in AI capital expenditures for 2026. This is not a company in distress, right? It's a calculated reallocation. They're actively transferring value away from the human payroll. Humans need benefits, they suffer from wage inflation, they have physical limits. Instead, that money goes straight into the asset layer: silicon, GPUs, data centers. Silicon doesn't ask for a raise, and it scales exponentially.
But here's where things get concerning: the macro prisoner's dilemma.
When we zoom out from the individual corporate balance sheet, this cold calculus introduces a terrifying systemic vulnerability. It's a classic macroeconomic prisoner's dilemma. Remember, consumer spending makes up 2/3 of the U.S. economy. Firing workers to boost margins makes perfect sense for one company trying to please its shareholders. But if every company in the S&P 500 adopts this efficiency through elimination paradigm, they risk completely hollowing out the middle class. Institutional research is genuinely warning that a mass reduction in disposable income triggers Great Depression 2.0 risks. If the middle class shrinks, the velocity of money stalls out. Fewer people buy cars, take out mortgages, or buy consumer goods. That revenue growth investors love so much today, it will inevitably evaporate if the consumer base fundamentally shrinks.
And yet, despite those massive macro risks, the cultural momentum in tech is only accelerating. Take this quote from Jack Dorsey, CEO of Block. 100 people plus AI equals 1,000 people. This was the logic he used when he cut his global workforce by 40%, dropping from 10,000 employees down to just under 6,000. It perfectly captures what Silicon Valley is now calling the mini AGI mindset. Traditional management hierarchies are obsolete. Headcount isn't a status symbol of growth anymore. It's strictly viewed as a liability, an anti-pattern to success.
Which leaves us staring right at the ultimate paradox of the Quiet Layoff portfolio. If corporations successfully engineer an economy where AI replaces the vast majority of the human workforce, who is actually left with the disposable income to buy the products generating these record revenues? Are we basically engineering record profit margins today at the absolute expense of our consumers tomorrow? It is a sobering question, and it's not just a philosophical debate anymore. This is the very real data and the exact operational calculus that Wall Street is actively trading on right now. Thanks so much for joining me on this explainer, and keep learning.